Ladies and gentlemen, welcome to our advisory board discussion for the fourth quarter 2020. It is a great pleasure having Lyn Alden as a special guest. Lyn, thank you very much for taking the time.
Yeah, thanks so much for having me.
Jim, thank you for taking the time as well.
Glad to be with you all.
We are here in New Jersey. Lyn is in New Jersey. Jim is in New England. Mark is in Spain. And I'm currently in Vienna. So yeah, spread all over the globe. And we've got plenty of topics to talk about. Of course, this today, 2nd of October, when we are recording, lots of news coming out, especially that Donald Trump is now infected with COVID. Markets reacted quite strongly today. Now they're kind of bouncing back. But I think we will focus this conversation primarily on the topic of inflation. I would like to introduce our special guest, Lyn Alden, first. Lyn Alden she's let's say some kind of a rising star in the investing and the global macro world. It is really fascinating. How often you're featured nowadays in various podcasts and interviews. I really love reading your material, especially your last article on inflation and fiscal versus monetary policy was fascinating. We will put a link into this publication and under the video. And I would just briefly read your biography. Lyn Alden's background blends engineering and finance. She's the founder of Lyn Alden Investment Strategy, which focuses on fundamental investment opportunities with a global macro overlay and reaches over 100,000 readers per month. Her asset class specialties include equities and precious metals, while her macro research emphasizes turning points for fiscal and monetary policy that can heavily influence the performance of various asset classes worldwide. Lyn, thanks for taking the time again. It's a great pleasure. Just a very, very quick note, what happened on our side, some housekeeping. We just published our chart book on gold, which is basically the summary of our In Gold We Trust report. As you know, the In Gold We Trust, the last edition, do I have it somewhere? Yeah, there it is. 350 pages, and I know that not all people had the time and interest to work through that brick of a report. So we said, let's publish a more chart-driven publication. So we just put out this chart book. Then we're working on a special report on inflation that should be out in a couple of days. We already started working on the In Gold We Trust report 2021, as well as the Mandarin edition of the In Gold We Trust report. And I attended some mining conferences recently, especially the Beaver Creek Show and the Precious Met and the Denver Gold Show. I attended more than 70 meetings with mining executives, and it was pretty interesting to see that sometimes I felt like at a value conference, because those mining executives, they were talking about record free cash flow, about raising dividends, about their strong balance sheet, reducing debt. And it's really fascinating to see how the mining industry changed over the last couple of years. I'm pretty sure that many companies will screw it up in this bull market again. But at the moment, I think that you can find a tremendous amount of value on the balance sheet of some mining companies. So that's it basically, and we can start with our conversation. And Lyn, I would love to, ladies first of course, I would love to hear your opinion and perhaps a brief summary of your most recent research piece that I already mentioned. It covers a century of fiscal and monetary policy, inflation versus deflation, and the long-term debt cycle. It is great because you feature lots of 100-year charts like we do as well. And I would ask you, could you give us like a brief overview about the findings of this tremendous piece, especially when it comes to this interplay between inflation and deflation?
Yeah, absolutely. So, that piece kind of examines the long-term debt cycle, which was popularized by Ray Dalio, but it kind of goes into more detail on that subject. So, the normal business cycle, you have increasing leverage throughout the business cycle, and then there's, it either pops by itself or some external catalyst hits it while it's fragile. And so you get that, that deleveraging event, that recession. But then, the way the current monetary system works, they come in, they lower interest rates, they usually do some sort of fiscal stimulus, and they start pushing that leverage back up. So over the course of multiple business cycles, you keep building up higher and higher levels of debt. So you keep reaching higher highs and higher lows of how much debt is in the system relative to GDP. And on the other hand, you have interest rates, hitting lower lows and lower highs. And that continues really until you hit the zero bound. And that's where a lot of things start to change because central banks pull out another tool, which is asset purchases. But then on its own, that's only, especially for treasuries and mortgage-backed securities, that's only so useful. And so what we generally see in history is when that starts to be reached, that's when we see usually more fiscal stimulus. So we see, greater kind of fiscal spending into the economy or tax cuts with the central bank kind of monetizing a lot of that treasury issuance. And so if you go back over the very long term, the last time we had a long-term debt cycle like this was the 1930s and 1940s. And so, ever since the global financial crisis, we've been kind of working our way through this kind of second, 80 years later, this second long-term debt cycle. So the article kind of just explores that whole like long-term relationship, comparing debt to GDP, debt to broad money supply, velocity, inflation, and kind of how, over the long term, all that debt and all that, technology growth is very disinflationary. However, in these extreme kind of long-term debt cycle environments, usually policy comes online and kind of counteracts those deflationary forces and ends up being inflationary in the end.
Excellent. Well, from our point of view, this interplay between inflation and deflation is also something that is crucial for our investment process. And we see those deflationary pressures at the moment still being kind of overwhelming the
Yeah.
inflationary forces. But it seems that, having a look at commodity prices, for example, at the price of gold, at the gold silver ratio, it seems that inflation is about to become a topic. Now, Jim, already the last time we spoke about velocity at length, and a question that comes up pretty often, and I talked about that in an interview recently, because I was asked, do you think that if we get this COVID vaccine, whenever it's going to come, do you think that it will basically crash the price of gold? And I said, perhaps it can put some pressure on the price of gold. But on the other hand, I think this might really be the point in time when confidence comes back into markets, when people realize, okay, there's light at the end of the tunnel. And this might also be the point in time when velocity finally picks up, when people start spending, and probably the point in time when central bankers would have to become more hawkish, more restrictive again. I'm absolutely certain that they won't act at that time because it would probably crash equity markets. So what do you think about this theory that actually a vaccine might be the real trigger and the point in time when this paradigm shift from deflation or disinflation to rising inflation finally starts coming?
Yeah, I pretty much disagree with all of it. But that's okay. We had a good debate going. So the vaccine itself, we may or may not see one in some reasonable period of time, defined as 6 months or so. Now, just to drop a couple of cautionary footnotes, this is COVID-19. Well, actually, SARS-CoV-2 is the virus. COVID's the disease, but SARS-CoV-2 is the sixth coronavirus that has made it to humans. I'll leave aside whether it came from a wet market or a laboratory. That's a whole separate debate. But be that as it may, it has made the transition from animals or some petri dish version of that to humans. The sixth time. We are 0 for 5 in terms of vaccines in doing this. There's no vaccine for MERS. There's no vaccine for SARS. For that matter, it's not a coronavirus. It's a different virus. There's no vaccine for HIV/AIDS. There are treatments, and thank goodness, and you can get on with your life. And there's other viruses have kind of died out, but I mean, they're still around in a biological sense, but they're not, we're not in a pandemic or even an epidemic at this stage. But if you're 0 for 5 and this is your sixth try, maybe we'll do better. More resources are certainly being poured into it. Technology has advanced, so there's some reason to think that we might get a better outcome. But I would be a little bit cautious about that, number one. Number two, even if we get it, the logistical issues, you have to prepare 1 billion doses. You've got to distribute it. Depending on the particular vaccine, a lot of this has to be refrigerated from start to finish, and until you get it actually to the patient. There are going to be political issues. Who gets it first? Depending on who kind of invents it or discovers it. So, and then beyond that, there's some evidence that if you get the vaccine and it works and it produces the antibodies that you want, that they may wear off in 6 months or so. So you may need booster shots. So take everything I said and multiply it by 4 times a year. It doesn't mean we shouldn't try. It doesn't mean we won't get it. We may well, but I would just be a little cautious about that in the first place. But let's say we do get it. In my view, what has happened in the last 6 months, well, 9 months at this point, is we'll have intergenerational effects. This is not something that you get over in 30 days or 30 weeks or 30 months. This could have impacts that go on for 30 years. And I would point to the Great Depression. I don't think there's very much. I mean, I like what Lynn has done in the sense that, I'm a big fan of 100-year time series. I think one of the problems on Wall Street, one of the problems with a lot of analysts, they'll do a 20-year time series or 30-year time series and say, what a good boy am I? Look at all this data. And it's like, that's like maybe 2 business cycles, with no depressions, no wars, et cetera. If you really want to know what you're doing, go back at least 100 years or maybe even 150 years at this point to the long depression of the late 19th century. That's a much better database. And it includes the Great Depression, which I think that's where we have to look. There's not much in the 2008 global financial crisis, the dot-com crash, the 1998 long-term capital management Russia crisis, the 1994 tequila crisis. They're all worth studying. They're all good case studies in financial panic. What we have now is not a financial crisis. We have an economic crisis. All the other ones I mentioned were financial crises that played out in the economy. I'm not saying there's no economic impact. There was, but they were financial crises. This didn't start in the banks, and it's not in the banks yet. It may end up there. Give it enough time, enough bankruptcies, enough failure, enough, if the disease lasts longer, and if you get the kind of behavioral effects I'm describing, there may be enough losses that it ends up in the banks. But we're not there yet. But this is an economic crisis. But you really do have to go back, I think, to the 1930s. Now, I make the point that I grew up in the 1950s and the early 60s, which was a very prosperous time in the U.S. economy, and Europe was recovering after the devastation of World War II, and so was Japan. But so I didn't live through the Great Depression, but my parents did, and my grandparents did. And when we were 10 years old, our parents would send us out with little wagons, little red American Flyer wagons, and we would go up and down our neighborhood and collect tin cans and newspapers. And we would take them to a center. There's always the Boy Scouts or somebody had a little depot, and might have been good for the environment. We weren't doing it for environmental reasons. We were recycling. There was steel in those tin cans. You could build, jet planes. In other words, we had a World War II depression mentality, even in a period of prosperity, because that's how we were raised. Because that's how our parents lived. When you got the newspaper delivered in the morning, you took the rubber band and put it in a jar, because why would you throw away a rubber band? that was valuable. And so, and that didn't change until the late 60s. You have to go to the late 60s when the baby boom generation kind of came of age. And okay, then it changed. Then the lessons of the Great Depression were forgotten. But my point being, that was 30 years from, say, 1935 to 1965 before that really wore off, and it was intergenerational. That's the kind of thing we're looking at right now, in my view. And just to back that up a little bit, I like Lynn's 100-year time series, but there was a study that came out that had a 650-year time series, and it was actually produced by an economist at the research economist at the Federal Reserve Bank of San Francisco, and 2 academic colleagues. It's online. I could send you guys a link. It's not hard to find. But they looked at every pandemic from 1350 forward in which 100,000 people or more died. So the fatality count was their metric, 100,000 or more fatalities since the Black Death, which approximately 1350. There were only 15. There weren't like 100 or whatever. There were only 15 that were that bad. Most of them had between 100 and 200,000 fatalities. There were 4 that stood out. The Black Death itself, about 75 million. The Spanish flu of 1918 with about 100 million. People still aren't sure, but that's the best estimate. And the Asian flu of 1958, and the Hong Kong flu in 1968, and now this one. Now we're at 200,000 fatalities. Sorry, that's just in the United States. The global fatality count is higher. It's close to a million.
I think.
Yeah, it's close to 1 million. That's right. But the point is, this is going to be on a list of 15. This is going to end up being kind of number 4. So it's not even back in the pack, number 13 or something. It's going to be the 4th highest fatality pandemic in the last 650 years. But what they did is they looked at the economic effects of it. They're not epidemiologists. They had the data. And they said that things don't normalize for between 30 and 40 years. So when the Federal Reserve recently came out and said, we're not raising interest rates until inflation is 2% or higher on a sustained basis. So it's not like, oh, you hit 2% on core PCE deflator year over year for 1 month, hallelujah, let's open the champagne corks. They said, no, we got to see 2% or higher on a sustained basis with some reason to believe that that's going to continue. That's their benchmark for raising interest rates. Well, okay, if that's your benchmark, then you're going to see rates of 0 until 2030. So this is as far as velocity is concerned, my view that inflation has nothing to do with monetary policy. So I can skip that debate because there's ample evidence that monetary policy, money supply, measure-based money, has nothing to do with inflation. Inflation is driven by velocity. So, for example, right now the Federal Reserve balance sheet is about 7.2 trillion. But I remind people that 7.2 trillion times 0 is 0. In other words, even if you take the quantity theory of money, which is a key to Austrian economics, monetarism, even neo-Keynesianism, and it's a definition. No one really disagrees with the definition. The predictive analytic power is up for debate. The ability to guide policy because of it is up for debate. Milton Friedman thought you could set money supply on automatic pilot because he believed incorrectly that velocity was constant, which it clearly is not. But the point being, if you had a much smaller money supply, much higher velocity, that would cause inflation. A gigantic money supply with lower velocity causes disinflation or deflation. In other words, the explanatory variable is velocity, and the problem with velocity is psychological. The Fed can get base money to 2 decimal places. They can stick the landing, and so can other central banks. They can stick the landing. They can make it whatever they want. That's very straightforward. M1, M2 depend on what the banks are doing. They're the real creators of money. And so far, they've been getting the money from the Fed, who's buying treasury notes, and then they take the money and give it back to the Fed in the form of excess reserves. The question is, where's the lending and spending? You don't see it. It's not there. And that's psychological. So if we, for us on this call, if we all feel that, happy days are here again, we feel prosperous, we like our prospects, we go out to dinner, drinks on us, party all night or whatever. That's one state of the world. But if you stay home and watch television, the velocity of your money is zero. And that's back to what I was describing. By the way, velocity has been declining since 1998. It's not specifically a function of the 2008 financial crisis or the 2020 pandemic. Now, those did give it a little steeper pitch. Yes, velocity went down at a faster tempo, but it's been going down for 22 years. So that suggests that the causes are perhaps demographic. And if you look at the United Nations tracks global population, but it's a big lift. So they do it kind of every 5 years or 5-year brackets. But if you look at the second derivative of global population growth, it really just slammed on the brakes in 1995. World population growth didn't go down, still going up, but it went up at a much slower tempo. So it's that second derivative effect hits in 1995. Does that have anything to do with it? I don't know. These are big questions, but my point is, I think the greatest economic danger right now is deflation, not inflation. My view is that's behavioral, i.e. velocity, which is psychological, has very little to do with money supply. And the effects of what we're seeing will be intergenerational. So this may be with us for 30 years.
Great. Well, what I take away, that's a very interesting point. Jim is managing our expectations when it comes to vaccine, first of all. So that's, to me, a very interesting insight. And obviously, you give a good statement for the case of deflation. What I would like to explore a little bit, how could we potentially come from this deflation to inflation? I mean, we've got this one precedent, or this one scenario which Jim also often mentions, basically a revaluation of gold. I would like to talk about that a little bit later, but I would like to hand it over to Lynn again, and I'm sure she has a lot of views to add on what you just said, Jim. Also, especially perhaps if you could incorporate your views. Do you agree with Jim with in regard to deflation, or how could you envision this kind of transition from this deflationary environment to a more inflationary environment, which you expect at the end of the day too, as I understand it?
Yeah, absolutely. So I agree with large chunks of that. The majority of that. Of course, everything said about the virus and the vaccines, that all kind of mirrors research I've done as well. That as far as I can tell, that's all correct. I've kind of seen the same thing. We've never had a coronavirus vaccine. So it's kind of, we're going to see how this plays out over time, how it changes behavior, how our immune systems kind of respond to it, and how it hopefully becomes less intense of a virus. But we'll see what happens. It's not really my particular expertise. Going back to the velocity question, I mostly agree, but with certain kind of small differences, which is that velocity, for example, is one of those things where it takes a pretty small change to kind of change that outcome. So it is absolutely true that if you have, for example, a massive broad money supply increase, but a very rapid decline in velocity, it offsets it. So you don't actually get that inflation. But for example, if you look at, say, the 1970s, velocity was actually lower than it was in the 50s and 60s, even though inflation was higher. And you had basically then you had an increase in broad money supply, but you didn't really have any more of a decrease in velocity. You kind of had like a choppy kind of static velocity going on, and a rapid increase in M2, and that was enough to produce inflation. So if you look at, say, a 100-year chart, the year-over-year rate of change of M2 is heavily correlated to inflation, but with certain caveats, where there's certain kind of years where that doesn't play out because you get a big deflationary shock, a big decrease in velocity. And by the time we actually see kind of potentially velocity increase, it would be somewhat coincident with inflation. So I do absolutely agree that if you have sharply decreasing velocity, and because of the demographic backdrop, we are in kind of a structurally disinflationary environment. And there's a couple kind of potential ways that policymakers might try to get out of that. So if you look back, in the long run, when we do get to these points in the long-term debt cycle where there's so much leverage in the system, growth is extremely sluggish, it's absolutely true that banks don't lend. They just they stick it, all their money's in excess reserve. It's all in treasuries. Right now they have among the highest level of combined, cash and treasuries as a percentage of their total assets, in decades. They're just very heavily involved in those safer assets, partially for regulatory reasons, but also partially out of choice. And so historically what happens is that the only other way that they can go around that to some extent is the fiscal policy. So if banks aren't lending, one option that the government historically has is that they can go around and do fiscal policy. So that could either, that could be, for example, spending in the sense we saw in the 1940s. Of course, we had the war spending. Or this year we had the stimulus anti-pandemic spending, so the stimulus checks. On the other hand, it could be tax cuts as well. It could be, for example, a payroll tax cut or something that gets more money into the hands of the middle class. And so I think over the long term, one of the reasons we've seen a decline in velocity is that we've had ever since roughly the late 1970s, we have an increase in wealth concentration. So most of the increases in wealth and stock appreciation and house appreciation and money supply increases has really concentrated in the top 10% or so. And that partially affects the circulation of money, because if the middle class does not have a ton of money, if their income's not going up quickly, it's harder for them to circulate money. And for example, if you have, say, a multi-billionaire and he gets another billion, it doesn't really change his spending habits too much. Whereas if you had, the middle class each get, say, a $2,000 tax cut or a stimulus check, whatever the case may be, depending on who's running things, that can potentially be more stimulative, which is what we really saw from, for example, April through June when we saw this rebound. So that's what I'm watching for, is to see how large deficits are going to be, either from spending or from tax cuts, as well as how that's going to play out over time. And I know one thing that Jim has talked about before is that the central bank has some other options available too, like repricing gold, for example. They have other tools that are outside of the normal toolbox that they can go to if they want to have a more intentional devaluation.
Well, great addition to that. I was hoping to have this debate, if you will. Jim, any thoughts to add? I'm sure you have.
Yeah, of course, Lynn is absolutely right. The quantity theory of money supply times velocity equals nominal GDP. So that's definitional, and no reason to dispute that in its own terms. And yeah, if velocity is constant and money supply goes up, the nominal GDP goes up. And then the question is how much of that is real and how much of that is inflationary. And that has to do with capacity for growth in developed versus developing economies, et cetera. So that's all, that's all basic monetarism, except that Milton Friedman assumed that velocity was constant, which means that you only had one variable to deal with, which is money supply. And you could just dial it up or dial it down. And if you thought maximum real growth is 3.5% inflation, then just don't dial it up more than 3.5% real growth, and you'll have zero inflation, maximum real growth, and constant velocity, and money supplies on autopilot, and it's all good. None of that's true because velocity is not constant, but it is true that you don't need velocity to go up if it's just constant, and money supply goes up, then you'll get higher nominal GDP. The problem is, as I said, is not constant, it's going down. And Lynn's exactly right. The increase in the money supply is barely compensating for the decline in velocity. And the result is constant nominal GDP. But what do you do in a world of constant nominal GDP when the debt's going up? And the problem there is, I like to, I think one of the biggest, it's simple, but one of the biggest analytical failures of a lot of Wall Street economists and analysts and commentators, et cetera, is they just don't take a second. They don't, take a beat and think about the difference between real and nominal figures. When people say interest rates are at an all-time low, we're close to it. And no, they're not. Nominal interest rates are close to an all-time low. Real interest rates are still pretty high, even if they're slightly negative. I always go back to the 1980, the period Lynn referred to, late 70s into 1980. I borrowed money at 13%, and when I told my mother, it was my first mortgage. And I told my mother, and she cried because her first mortgage was like 2%. But I said, Mom, yeah, I borrowed money at 13%, but inflation is 15%. So my real pre-tax rate is -2, but my interest is tax deductible. And I was living in New York at the time. Taxes were 50%. So my after-tax real rate of borrowing was -8.5. That's a low rate. And that's the kind of rate you need to get velocity going. Say, okay, yeah, I'll go buy something at this rate. So my rate was -8.5% after tax. So even if rates are kind of negative 50 basis points right now, which is about what they are, maybe they're not even that low, those are high real rates relative to all the headwinds that the economy is facing, and not nearly enough to get us into to growth or expansion. So rates have to go a lot lower, a lot lower. Now you're at the zero bound, which Lynn pointed out. That's absolutely right. I doubt that the Fed is going to set a negative policy rate. I could be wrong. Maybe they will, and the Europeans have, and Switzerland, Japan, Sweden, a number of other countries have done that. But they've done it for a long time, and now we have some evidence. The evidence is that it doesn't work, and this, in other words, it's not more of the same. Cutting rates from 1% to 0 can help. Cutting it from 0 to -50 basis points or 25 basis points, the evidence is it's not more of the same. You've passed through what physicists call a threshold, a critical threshold. You're into what's called a phase transition. And I'm not using physics gratuitously. If you believe, as I do, and the evidence is good, that capital markets and financial markets are critical, or sorry, complex systems, and exhibit complex system dynamics, then you can use 80 years of science and complexity theory to understand it, which I think is very, very effective. But the point about going through a phase transition is you're in a new world. It's, kind of, you use a literary metaphor, you're now through the looking glass. And so why do central banks go to negative rates? Well, it gets back to this velocity issue. They go, well, okay, I cut your rates to 0. You're still not spending. You're sitting here, you're home watching TV. You're not spending the money. Now I'm going to make it negative. I'm going to take your money away. You put $100,000 in the bank. You go away for a year, and you come back, and you have 990,000, or sorry, you have 99,000 left. I had a 1% negative interest rate. And so I'm going to keep taking your money away. So you better go spend it. So that was the expected reaction function. It was supposed to have a stimulative impact, but that's not what happened. What happened is people have lifetime goals. They're saving for their retirement, buy a house, their kids' tuition, their healthcare, their parents' healthcare, whatever it may be. When you start taking the money away with negative rates, they actually save more. They go, well, I got my goals are the same. You're taking away. I better save more, because how else am I going to hit my my target savings rate? And by the way, what is the central bank saying to you and to the world when they have negative rates? They're saying they're worried about deflation. Well, if you're sending me a deflation signal, why should I buy? I'm going to wait till prices go down. In other words, you have to be a central banker and academic to think that that is stimulative. It actually has, in the real world of people making decisions, it has the opposite effect. It sends a deflationary signal, which makes you defer spending, and it makes you're hitting your lifetime goals more difficult, which makes you save more. The exact opposite of what central bankers want. And that's showing up in a lot of evidence, particularly from Europe. That being the case, I think the Fed is onto this. I've spoken to some Fed officials about it, and they actually, I was surprised at how well they understood it. So how do you get negative rates if the Fed will not have a negative policy rate? Well, the answer is the market can do it for you in secondary market trading and 10-year Treasury notes. And I use 10-year notes as my benchmark, not just from a trading perspective, but 10 years kind of corresponds to an investment threshold. Most mortgages, weighted average maturity of a mortgage is about 7 years. Most corporate boards consider it 5 years or longer to be what they consider long-term investment, et cetera. So it's a good proxy for that. But the minute a secondary market buyer pays a premium over par that's greater than the value of the strip of coupons, you have a negative yield to maturity. You're not going to get all your money back. You're going to get your principal back, but you're not going to get all your investment back because your coupons are not as great as the premium you paid. And that gives you a negative yield to maturity. So the secondary market can get us to negative rates, as it has in bonds and elsewhere, without a negative policy rate by the central bank, because that really only affects basically overnight money or very, very short-term money. So we may see negative rates. Now, think about that for a second, because this is just bond masters duration. The DVO1, the dollar value of 1 basis point of declining rates goes up at lower absolute levels of rates. In other words, cutting from, if rates go down from 50 basis points to 25 basis points, and you compare that to, say, going from 8% to 7.75%. Both of those moves I just described represent a 25% decline in interest rates. But the capital gain in the first one, when you go from 50 to 25, is much greater than going from 8 to 7.75. In other words, the bang for the buck in declining rates is much greater as rates are lower. So you're looking at huge potential capital gains on 10-year Treasury notes. If I'm right, and we go from, I don't know where it is today, about 70 basis points to negative 50 basis points, or negative 1%, not through Fed policy, but through secondary market trading, you're looking at huge capital gains. So this is why the bond bears, Gunlock and Dan Isaacson and Pimco and Bill Gross, these guys keep getting carried off feet first, because they're saying, the bond rates can't go any lower, the bull market is over, time to short bonds, and they've just been wrong for years because of the phenomena I just described. But you got to get rates a lot lower, or you're not going to get any stimulus. On the and Lynn mentioned fiscal policy. This is also subject to a phase transition. In other words, why does anyone care? Why does Angela Merkel care if debt to GDP ratios your sovereign debt to GDP ratios are above 60%? That's the Maastricht Treaty, threshold, and she's been fighting with countries in Europe tooth and nail to keep it below 60%. In 1980, the U.S. was about 30%. So everyone agrees that 30% is highly sustainable. 60%, yeah, okay, a little high, but you can get there. And Lynn mentioned that she's tracking these debt to GDP ratios. And I think that's important. That's one of the critical variables. But the research, and here I'm referring to Carmen Reinhart, who's now the chief economist of the World Bank, and Ken Rogoff is a professor at Harvard. Carmen was at Harvard before she took the World Bank position. And not just in their book, but in a large number of research papers, some of which they wrote together, other of which they wrote individually with other collaborators. And they've looked at debt to GDP ratios in developed economies, developing economies, all economies, 100-year time series, 50-year time series, through multiple debt crises in the case of each individual line item, a line item being a country. And they came up with one very consistent result, which is that 90% is the critical threshold. Up to 90%, you could have a Keynesian multiplier of greater than 1. Now, the whole Keynesian multiplier is a whole separate subject. Query whether you're generating real growth or just borrowing up from the future, whether there's a price to pay. But leaving that aside, it does work up to a point, but it's more powerful at lower initial levels of debt to GDP. In other words, if you're in a recession, or you're just coming out of a recession, and you have a lot of excess capacity, and you have a low debt to GDP ratio, there's very little doubt that government borrowing can substitute, and spending can substitute for private spending if there isn't any, if you're in a liquidity trap, and pull you out of a recession. But the problem is that multiplier goes down as the debt to GDP ratio goes up. That's the simplest way to put it. At 90%, you go through the looking glass, and now if you borrow so at 60%, if you borrow $1 and spend $1, you might get $1.10 of GDP. Above 90%, if you borrow $1 and spend $1, you get 95 cents of GDP. In other words, you're not even getting your dollar's worth. You're getting less than $1 worth. But meanwhile, your debt's going up by $1. So your debt to GDP ratio is getting higher, and you're making the problem even worse. So this is why you cannot borrow your way out of a debt crisis. You cannot spend your way out of a debt crisis once the debt to GDP ratio gets up where it is now. By the way, the United States has gone from 106% at the start of the Trump administration to will probably be 135%, because you got two factors going on. The debt just went up by $5 trillion, but GDP went down. So it's, it's a fraction. It's a numerator denominator thing. Numerator's going up, but the denominator went down because of the technical recession, what I would describe as a depression coming out of COVID. Well, we're not that far behind places like Greece, Italy, Lebanon. I mean, welcome to the club. So, but the point is, you can't get growth. So if fiscal policy, if monetary policy is impotent because of velocity, and a fiscal policy is impotent because you're across the 90% debt to GDP ratio, you can't get out of this.
Okay, a lot of thoughts. A few things to add also. I think I agree definitely with the statement you said that the US Fed is very hesitant, and I think will be very hesitant to go into negative rates. I think you brought very good arguments. I would add a few more arguments for that. First of all, they saw, as you said, it doesn't work. Second of all, I think if they really would pursue negative interest rates and these yields would follow through on the bond markets, I think that would be really detrimental for the reserve status for the US dollar, which they are probably well aware of and they will want to avoid. Thirdly, and this is a little bit in contrast to the European side, thirdly, what I think is also probably a factor is basically the stakeholdership of the Fed. So you have this semi-private, semi-public situation in the US, whereas in Europe it is much more public, and the commercial banks, I think, have less of an influence on the ECB. And also on the European side, I think the European side is more likely to follow through much, or will try to follow through even more negative rates, because, as I said, from the stakeholder ownership, they are more independent. Professor Richard Werner does quite a good job in talking about these kind of things, by the way. But also, when one looks at the developments regarding digital currencies, just today another push came out from the ECB members, from ECB officially, which was basically confirmed by most of the ECB members, talking very favorable about this research which the ECB produced now. So this push into the digital currencies, in my view, is also a prelude to try to push the interest rates more into the negative direction. So I think this could be something looking forward, which one should have an eye on. So what, perhaps as a final potential trigger for higher price inflation, and I would like to again give it back to Lynn then, I would throw into the room, what about the potential of severely weaker US dollar? Could that potentially trigger inflation not only in the US, perhaps even globally, due to rising commodity prices? What are your thoughts?
I think potentially. So going back to what Jim said, I absolutely agree with the first part that, from what we've seen, lower and lower interest rates beyond a certain point really kind of run out of fuel to do much more. And so I've actually had some debates with people before that they insist, if they cut to negative interest rates, that'll help things. And there's not really any good evidence that going lower and lower into negative territory for interest rates would kind of fix this problem. As far as fiscal is concerned, there's a couple of different ways to look at it. And one study that I referenced was from, I believe it was Hirschman Capital. They looked at 200 years of sovereign debt to GDP. And they found that whenever a country gets over about 130% of GDP, debt to GDP at the sovereign level, in one shape or another, those bonds end up not getting paid back in real terms. And that can take a variety of different forms. So a lot of it comes down to whether or not it's a monetary sovereign. So if they control their own currency and those debts are denominated in those currency, or if they're part of a union, or if it's an emerging market that has, say, dollar obligations. So there's kind of different shapes that can take, and it whenever they get above that kind of event horizon, it becomes virtually impossible to pay it back. And so what happens is they either have a nominal default in some cases, especially if it's obligations they can't print, or they pay it back, but in say devalued currency. For example, you have kind of an inflationary impulse, and you have kind of deeply negative real yields for a while, and so bondholders get everything back, but it's not the same purchasing power. And so I think they studied 52 such cases that they could identify in that 200-year period, and so far 51 of them over the next, call it 15 years, bondholders didn't really get their money back. And the one exception was Japan, because they've managed to push their situation longer than most. They have positive current account balance. They have very homogeneous culture. They have the largest absolute net international investment position, pretty high net international investment position as a percentage of GDP. So they have kind of a lot of aspects that allow them to push that pretty far. For the United States, we have kind of a somewhat of an opposite situation, where we have pretty large twin deficits. So we're running big fiscal deficits, but we also have a trade deficit and a current account deficit, and we have a negative net international investment position now. And in recent decades, it's gotten worse and worse. On the other side of that coin, of course, we have the global reserve currency. So we have kind of a persistent level of demand for that currency from abroad. And there's a lot of U.S. debts that are denominated, U.S. dollar denominated debts held by entities outside the U.S. And so that all kind of represents demand for the dollar. So my base case since late 2019, around during that repo crisis, was that in the years ahead, we would see a decline in the dollar. If you look at kind of that 50-year cycle ever since we've the 1971 transition, we've had kind of three really big dollar spikes. So we had the big dollar spike in the 1980s, we had the second one in the late 90s, and then we had the third one ever since around 2015. And so my base case is that we might be kind of teetering over on that third spike, and then we could get a downward move compared to some of the other major currencies. But that's going to, there's a lot of factors that go into that. There's, because you're not just devaluing in a vacuum, you're comparing that currency to other currencies. So on one hand, many of those other currencies in that basket have positive current account balances, and but on the other hand, they have their own issues, right? So many of them have lower nominal interest rates, for example, or other things that can weaken their currency. So my base case has been to see a weaker dollar in the years ahead, but it will depend on a lot of factors. And going back to the fiscal situation, from what I've studied from history, is that basically, as sovereign debt gets higher and higher, it does become less and less effective. But when you hit a certain point where you're monetizing large portions of that debt, so for example, the Federal Reserve's creating new bank reserves and buying that large swaths of that treasury issuance, that tends to be somewhat more inflationary, in the sense that if you can get a lot of money into the hands of people, and again, it's either in the form of they could call it helicopter money, or they can literally just do, say, a payroll tax cut. So they're taking less money out of the economy. That tends to, in the end, be somewhat inflationary. And what, I think from the Federal Reserve standpoint, I think Jim pointed out that they seem to realize this to some extent. And if you look at pretty much every time Powell speaks, he always asks fiscal authorities to do more. So he's basically saying that he's not going to stand in the way of inflationary pressures. He's going to hold rates as at near zero as long as he has to. And he's basically saying that, it's kind of fiscal to step up, and that they're willing to keep monetizing that treasury issuance. And so, I think if you had, for example, a big payroll tax cut, or, more rounds of helicopter spending, or depending on who wins the election, if you have some more MMT heavy policies, I think that inflation would be on the table again, because even though you have a very large disinflationary backdrop, some of the amount of kind of deficit spending, a lot of it monetized, could be quite inflationary. So what basically in kind of my process, we have this kind of longer term kind of base case, but then we monitor it quarter by quarter. We see, okay, what is stimulus doing? What are real rates doing? What are, basically we're following a lot of different indicators to kind of see how that's going on. And ever since this last round of fiscal stimulus mostly wore off in July, we have been kind of back in a disinflationary mode. So we had that kind of inflationary or reflationary kind of partial rebound during this kind of heavy stimulus period. But now we're kind of back in like reality setting back in. Stimulus talks have been in gridlock. We have kind of this, wobbly recovery kind of happening now. so for the time being, I am kind of near term in a disinflationary mode because the natural tendency for such a leveraged system and kind of slower demographics and, to Jim's point, the changing behavior around the pandemic, all of those kind of represent very strong disinflationary trends until otherwise.
Thanks. I mean, I didn't want to talk too much about the politics, but I mean, it is, and you brought it up now, it is probably a determining factor for the fiscal policy going forward. So I don't know if you both of you have some kind of scenarios, I guess so. What potentially could happen depending on the outcome of the vote, and I'm not only referring to obviously the presidential vote, but also the congressional vote. I think that would be very important how the combination of these two elections will actually fall out. Any thoughts in that regard?
Jim, I think you said the last time that you see it 50-50, the odds, Biden versus Trump. Did that change significantly recently?
Well, significantly is a loaded word. Yeah, I would say it's leaning in Trump's direction. So I would make him a slight favorite, but it's close. So you can't. 2016 was easy. I just said, Trump's going to win. I was, went around the world saying that on a lot of network TV broadcasts. Mm-hmm. That was an easy call for like 5 people. Everyone else thought Hillary was going to win. But this time it's just close. I mean, that's just being realistic. That's not being wimpy. But I would make Trump a slight favorite. But it's not the only issue in play. As Mark points out, the congressional makeup, the Senate's going to be close. The shorter term problem, I guess it's a 35-day problem right now, is we're going to have an election and not know who won. Now I can say that Trump will win at the end of the day, but some of the key states, and I'll put Pennsylvania at the top of the list, is for the benefit of anyone watching this, I travel around the world, speak to a lot of international audiences, and people come up to me and they go, Jim, I could be in Australia or Germany or anywhere, and they go, we really don't understand U.S. politics. And I say, well, don't worry, neither do Americans. But the fact is, we don't have national elections in the United States. We don't. We have 50 state elections plus the District of Columbia. They add up to an outcome that gives us a president and a vice president. But if you want to understand it, you just have to go state by state. Well, it turns out that there's a very high correlation between the individual states that will make the difference in the winner, which would be Pennsylvania, Michigan, Wisconsin, Ohio, a few others. Not all of them, but the ones I mentioned and a few more. And the states that are making strenuous efforts to increase mail-in balloting for the first time. Now, there are certain states, I would say Oregon is one of them, where they've been doing mail-in ballots for a long time. They kind of know how to do it, and the voters are familiar with it, and they're geared up to count the mail-in ballots. But some of these states, Pennsylvania, again, is a good example. They're doing it for the first time on a mass scale. Now, you've always been able to get an absentee ballot, but that's very formal. You got to go down to town hall or call them up and request it and show your ID and fill it out a certain way and get it back by a certain date, et cetera. No one really has a problem with that. We're talking about mailing, 5 million ballots to like random addresses and hoping for the best. Leave aside, ballot harvesting but I point out Americans can barely figure out how to renew their driver's licenses. You think they can vote by mail if they've never done it before in a state that's never done it before? You got to fill the thing out a certain way and sign it. Maybe some states no, but then you got to put it in a security envelope, put that inside the bigger envelope and put a stamp on it and get it in time. That's a lot of steps. I mean, people, they're forgetting the security envelope. They're forgetting to sign it. Some people put stuff in the mail and don't put a stamp on it. I mean, a lot of ways for it to go wrong. So now you flip over to the courts, okay? Those ballots are going to end up somewhere. They're going to come from somewhere. And should we count them or not? Well, under the formal rules, a lot of them are going to be disqualified or should be disqualified, as many as 30% by some estimates. But what if those votes are heavily from let's say, pro-Biden districts, inner cities, the places that are favorable to Biden, and there's a disproportionate disqualification effect, not because of any fraud, just because people didn't follow the rules. Well, you can go to court and get some judge to say, well, every vote counts, so we're going to extend it for 5 days, or, if the ballot shows up within a week after the election, we're going to count it, even if it's not postmarked, et cetera. I don't get too bogged down in this. I could go on for hours of all the ways this can go wrong. But the bottom line is, and then so you just find yourself a nice liberal Democratic district court judge to give that order. Well, here comes everyone says Biden has 600 lawyers, which he does, but Trump has like 700 lawyers. So now you appeal to the Circuit Court of Appeals, and you're walking into a courthouse that's probably a lot of Trump judges, because they've been confirming judges like crazy. And then it works its way up to the Supreme Court, where we have a vacancy. Like, what else can go wrong, But they're trying to fill that before the election day. So this is a nightmare scenario. My point is, we could be sitting here in mid-November or later, counting ballots by hand under judicial supervision with independent monitors and impounded ballots, not knowing who's the next president. So, so saying that on form, using my predictive analytic models for elections, that Trump's a slight favorite is one thing. But if you just throw in all these wild cards, all this chaos, which I think is likely, by the way, these are not highly attenuated nightmare scenarios. They're actually probably what's going to happen. How does that affect markets? Probably, good for gold, just goes to the search I'm safe haven effect, independent of everything else. If Biden wins, he'll be president for probably 6 months or something, and then he'll be ruled incapacitated, and then Kamala Harris will become acting president, and then here comes Stephanie Kelton, my buddy, the modern monetary theorist, who and the Bernie Sanders wing and others who believe that, and we just, Lynn and I just went through the 90%, 120% debt to GDP ratios. What does it mean? That's an important topic. Try 250%, because they look at Japan and go, hey, Japan's 250, and it is. And so if you say, okay, obviously we just increased our deficit by $5 trillion. But maybe that was a necessary response to a once in 80-year economic collapse as a result of a pandemic, or there was no pandemic in 1929, but the economic effect was just as bad. If that was a one-time response and perhaps necessary, you can debate that. They're not necessarily geared up to do it again. At least the Republicans are not. But the Democrats may be, not because of the pandemic, although the pandemic is a very convenient excuse for people doing all kinds of crazy stuff that they haven't had the nerve to do. But if you buy into modern monetary theory, which the Democrats do, then there's no problem. Why not another $5 trillion? Unemployment's still around 8%, a little bit lower as of this morning. Let's get that back down to 4%. Well, is that a $4 trillion? Well, who cares? And that is what they're saying. So, but if what Lynn's referring to and what I'm referring to, and what Hirschman and Reinhard Rogoff and others have explored, that does not get you the growth you want, and it leads to a non-sustainable situation. So what you get back to in every case is the debt can't be paid in real terms. Now, and Lynn put it exactly right. You might get your money, but here's your $1 trillion, but good luck buying a loaf of bread. Mm-hmm. So the ways out are outright default, just I'm not going to pay you. Restructuring, which is we're going to turn them all into 100-year bonds or whatever, or inflation, which is here's your money, but it's not worth very much. There's no reason for the U.S. to do the first two, because for the reason Lynn mentioned, which is we actually can print the money, and it is a global reserve currency. So if you get to this non-sustainable situation where the debt does not produce the growth, it just gets worse and worse, then you pretty quickly get to inflation as the only way out. And that is the American way, which is, we've done it before. Civil War, 1919, late 1970s, it's the American way. But here's the problem. Inflation is clearly the only way out. but the Federal Reserve has forgotten, if they ever knew, how to cause inflation. Like I say, it's a sad day when you want inflation and a central bank can't get it. And that is the situation we're in. Now, I can give you inflation in 15 minutes, which is you do the following. You convene an emergency meeting, non-scheduled meeting of the Board of Governors, or the Federal Open Market Committee. You go in the boardroom with the Fed, you close the door, you take a vote, you walk out. Jay Powell walks up to the microphone and says, ladies and gentlemen, as of now, the price of gold is $5,000 an ounce. And we are coordinating with the Treasury. And if you think that's expensive, sell us your gold. We'll buy you the money. If you think it's cheap, back up the truck, come and get it. Fort Knox, the doors are open. In other words, if you use the U.S. reserve of 8,000 tons, divided between actually Fort Knox and West Point, and the printing press. So the printing press is the money side. The gold in the vault is the physical side. You can make physical delivery or add to the gold in the vault. And it's just an open market operation. So 5,000 is the target. You're a buyer at 49.95. You're a seller at 50.50. It's no different than buying 10-year notes. It's no different than buying treasury bills. I mean, when they want to increase the money supply today, what do? They buy treasury bills from the banks, from the primary dealers. Well, just buy gold. And for that matter, you're not limited to, nor should you be, to official gold. You can buy private gold. There's a lot of it around, more than the official gold. So if you make a two-way market in gold as an open market operation using the printing press and the vaults and hit a target, guess what? That's the price. It's the price because you say so and you stand up to the marketplace. The point of doing that is not to reward holders of gold. Yeah, gold holders will be happy, like, hey, I made a lot of money on my gold. That's not the reason to do it. The reason to do it is to break the back of the deflationary psychology, change what I described earlier as a high savings, low spending, low velocity environment where there's been an enormous change in, there's been behavioral adaptation of a kind we haven't seen in 80 years. Break the back of that and get the price of everything else up. And this is what FDR did, Franklin Delano Roosevelt did in 1933. He raised the price of gold, not to help gold holders. In fact, he confiscated all the gold before he did it, so it was the ultimate insider trade. But he wanted the price of copper, steel, wheat, corn, barley. He wanted the price of everything else to go up and change the psychology. And guess what? It worked. In the middle of the Great Depression, the stock market rallied in 1933, 34, 35. Those are three of the best years in the history of the stock market. Unemployment went way down. Now, the problem is you're starting off a high base. So unemployment went from 25% to 10%. But it was still 10%. I mean, it was still pretty high, but it was a big improvement over the 25% level. And the stock market went up. It did not recover the 1929 highs until 1954, but it was all because it went down 90% between 1929 and 1932. But it rallied. If you were buying at the bottom, you made money in stocks. You could do that again, but there's only one way to do it, which is to raise the dollar price of gold. And just, I'll shut up in a second, but just one quick footnote. When people say, is the dollar going up? Is the dollar going down? Is the dollar collapsing? Is the dollar maintaining strength? I blow a whistle like a referee and I say, time out. Compared to what? As people throw around phrases like strong dollar, weak dollar, dollar up, dollar down, and they never stop to think about the measuring stick. What are you using? Now, most people use either DXY, which is the futures contract, or they use the Bloomberg index. I use the Fed broad trade weighted index, and it sounds like, Lynn might be looking at those kind of indices as well. They're all fine, they're all useful, and they give you time series, but they're all currency to currency. They're basically the euro. All the not exclusively, but all the indices I just mentioned it's basically the euro US dollar cross rate, which is a terrible measure of dollar strength because they're all in the same lifeboat. It's like 15 major currencies, liquid tradable currencies, are like passengers in a lifeboat. Maybe some are taller, some are shorter, some are smarter, some are richer, some are poorer, whatever, but they're all in the same lifeboat and they're going to sink or survive together. There's no world where the dollar collapses and the euro is doing just fine. Hey, get me those euros, that world doesn't exist. If you're a short-term trader or you're a day trader or you're in the export-import business or you need to know this, a 6-month forecast on euro, US dollar exchange rate, that's valuable and the euro could go up or down, et cetera. But that really does not tell you anything about the fundamental strength of the dollar. The only way you can judge the dollar is the dollar price of gold. And the reason is because gold is money, but it's not a central bank currency. So it's the only objective measure. It's the only measure that's not printed by somebody else. And people say, Jim, you've been predicting the collapse of the dollar. It's never happened. And I said, yes, it has. It already happened. You just didn't notice. When the dollar price of gold goes from 1050 to 2000 in 5 years, which is just what happened since the low in December 16th, 2015. That was the bottom of the bear market. It's been going. It's up 100% since then. So the dollar, the value of the dollar against gold has collapsed 50%, 50 in the last 5 years. So you already had your collapse. It's going to get worse. It's going to collapse 80 or 90% before this is done. Gold's going to go to, my expectation is $10,000 an ounce. It's already happening, but most people don't see it because they're looking in the wrong place.
Can you see that on the screen?
Yes.
Just the yearly performance. I think it's just staggering, and people just cannot believe those big moves that happened. And perhaps coming to an end, Jim, it seems that you're slightly bullish gold, but also have a positive view on treasuries, which is very similar to what Dave Rosenberg, colleague that I really enjoy reading a lot, sees as some sort of a barbell portfolio, and I mean it has been a tremendous performer this year. I would say when we talk about gold with people that don't 100% get it yet or are not invested, most people say, well, it is already too high. We'll start buying gold when it's 1700 or 1800. And, during the correction over the last couple of days, we said, okay, so did you get in now? And said, we're not sure. So this is something that's clearly positive. We don't see any excessive optimism yet. On the other hand, I think, this combination of nominal rates being basically at zero until 2023 and average inflation targeting by the Federal Reserve, I think that's like the perfect setup for gold over the next couple of years. And it seems that what we really feel is the point when Berkshire Hathaway bought this, I think, 0.5% stake in Barrick Gold. I think this really meant a lot for many value investors. So it seems that there's a completely new group of people currently considering getting into gold and into the gold mining space. So, which is of course, something positive, because, at the conferences that we used to attend, you mostly see very similar people, but not really a new crowd or generalists coming into the market. And I think this is really something that developed over the last couple of months. So that's clearly positive. But Lynn, you're known to be pretty agnostic when it comes to gold. I think now you've got a pretty positive view. What is your approach when it comes to gold? How or let me ask it that way. For us, there have been some particular moments in life when we got gold. And when it finally made click, and for me, for example, it was the stock to flow ratio. When I learned about it and when I researched it and said, okay, it's mostly about the relative supply curves. It's about the stability, and that you just cannot be inflated at will, because the supply of gold is roughly 1.6% of the stock. So I would like to ask you, when did you understand gold? Did you have like a special moment, and what's your sense from talking to other colleagues and clients regarding gold?
Yeah, so I was lucky because when I was a kid, I started buying gold and silver coins, kind of a coin collector. And so that started, I had an uncle that he had all these cheap foreign coins, and I thought it was really cool. So I started collecting, those just kind of those the coins that aren't worth anything, but they all tell a story.
Hmm.
It's kind of cool for a kid to have that. But then I shifted into silver coins and very small gold coins at the time. Yeah, and so I already kind of had that baseline to be kind of comfortable with it, because a lot of people just don't know anything about it, don't know. So I think the valuable lesson I got back then was that I knew about inflation over time, even though I was a kid, I knew the general idea, and so I just kind of view my gold and silver as a store of value, and so I wasn't checking the price every month. I wasn't worrying about if it's going up or down $50. It just was like, this is the I kind of measured it in ounces rather than dollars at the time. And so I ended up selling that collection in 2011. I kind of accidentally timed it pretty well. It was partially because there's so much bullish sentiment and so
Hmm.
much extreme enthusiasm, and I sold it. But it could have been another world where it went up another 2 years, for example. So I got out of it there. In this current cycle, I became bullish on gold in 2018. It was pretty cheap back then because we had rising interest rates at the time, so I got into gold and gold miners back then, and of course we had this kind of a shift to lower and lower interest rates. We had reduction in interest rates by the Fed, but also we of course had the Treasury market price in much lower rates. And so if you look at real yields, they kind of hit that peak in 2018, and they've been on a pretty strong downtrend. And so there's a couple indicators that I use to value gold. So one is I compare gold to the growth of the per capita money supply as kind of a kind of a benchmark, and then I also overlay real interest rates on top of that. So if you look at, for example, gold, the year-over-year change in the gold price compared to real interest rates, you have a pretty strong inverse correlation. So when you get those big negative spikes in real interest rates, that's when you tend to get big spikes in gold and vice versa. And so using those two indicators together, that's kind of how I use as a kind of a band for what gold is worth in a normal environment. And of course, outside of that normal environment, you can get tail risks, kind of like the types of activities that Jim referenced. So, for example, the 1930s, of course, you had the depegging and the repegging of gold, so an intentional dollar devaluation. And there's always the possibility that you have another sort of accord or another kind of central bank policy decision that could do a rapid change overnight. So I think that the tail risk is to the upside in that regard. And I also monitor things like overbought conditions for kind of near term. I kind of set expectations for my readers. Like, for the past couple months, we've been warning that, there is a lot of kind of near-term enthusiasm, not necessarily excessive enthusiasm, but kind of a,
Hmm.
near-term momentum and enthusiasm. So we also saw a little bit of a rebound in real rates. So as we've seen kind of a cooling off of, the tips market, inflation expectations, we've seen a little bit of a rebound in real rates. So they're a little bit less negative than they were, say, a month ago. And so that kind of coincided roughly with
Hmm.
the correction we've had in gold, which I think is healthy in this environment. So, I think this opportunity is good for, dollar cost averaging into it. Each investor, of course, has their own kind of way of doing it. So, and their own kind of portfolio construction. My kind of I've noticed that from my readership and from people I talk to, it's kind of what was just said, that people are always kind of waiting for more dips. They're always kind of worried about if we get a big, say, a deflationary spike like we had in March. What if we get another one of those? Could we get another big gold sell-off? And everyone's kind of waiting for that one kind of trigger to buy gold, and it's always unclear if we're going to get that. It's possible that we have another March scenario, so we have another multi-$100 sell-off in gold. It's absolutely possible. But it's also possible that we just get little dips here and there, and that it doesn't really present those clear buying opportunities. So, I think having kind of a portion of a portfolio in it makes sense. Dollar cost averaging into it makes sense. And then investors, of course, have their own kind of tactical frameworks for, how much they want to trade it or hold it, and go from there.
And for the mining stocks, do you have rather, because from our point of view, it's probably the most top-down asset class you can own. I think if you don't catch the bull and bear markets in the mining space, I think stock picking doesn't really make any sense, because then you're just down 70% in the bear market and not down 85%. So what's your approach when it comes to the mining space? Do you have any sectors in particular? I don't know if you like royalties or the large caps, or do you go into the junior space?
Yeah, so over the past few years, I focused more so on the royalty companies, and so we've had kind of an emphasis on conservative play. And to your point, unless there are people that specialize in, say, picking individual juniors, which is that's not something I do. I kind of view it from a more macro perspective. So I use a combination of ETFs as well as individual stocks. But the individual stocks I select tend to emphasize strong management teams, good balance sheets. So I err on the side of broadly diversified in that sector, and tilting towards conservative, low production costs, low, strong balance sheets, and those sort of things. They're less explosive if you get a huge bull market, but they tend to handle those dips and those bear markets a lot better. And they still generally serve the purpose. So that's kind of the approach I've had, is to emphasize quality.
Excellent. All right, Mark, is there anything to add?
No, I think we covered a great deal of content. Two very fast and interesting speakers here, which is, I think, makes a great advisory board. And I would like to thank both of you, obviously, to come here, and looking forward to another one of these. Ronnie, some final words?
No, thank you very much for taking the time. Jim, I think your wife downstairs, she was, I saw her sometimes. Send her my best regards. I hope the family as well. And
yep,
Lynn,
you.
many thanks for taking the time. I hope you enjoyed that. And yeah, be good, be healthy, and let's hope for a interesting fourth quarter of this year. This has been great. Thank you very much, and take care. Thank you.
Yeah, thanks for having me.
Bye-bye. Thank you.
Cheers.
Bye-bye.
Bye-bye.